Hi everyone, Micy here. Thank you so much for joining. Before we get started today, just want to tell you a little bit about my company, Life Mission Capital. Disclaimer that everything that we talk about today is for general knowledge. For any accounting investment advice, please talk to your CPA or investment advisor about a specific case. So a little bit about me. There's a few pictures about me. My company is Life Mission Capital, but I initially came to the U.S. as an exchange student, and this is a picture of me and my host family and my family in China, that where I'm originally from, and my husband. Um, and since then, I really accidentally fell into real estate through house hacking in 2019. And since then, I invested in 158 units in single multifamily across both active and passive investment. And I started a real estate investment club where I also work Walmart, where we have more than 500 members as well. In fact, Brandon spoke at a club last year, and it was a really well received presentation. So I thought, it would be great if he can also speak with some of my investors in the company. So I started Life Mission Capital last year as a way to help people, busy professionals like me, to passively invest in real estate and help them achieve their financial freedom as well. I've been featured in some podcasts, but one of my favorites is Sotastic, where they talked about financial literacy for kids and just shared about my experiences. So why did I choose to invest passively through real estate syndications? Brendan will talk a little bit about here about the tax benefits as well. But really, I started with a single family home. I went to duplex. And then when I founded my company is where I realized I just don't want to deal with tenants and toilets anymore, even if I have a property management company. And those are some of the pictures from a tenant that I inherited that I no longer wanted to experience personally. So that's where I want to do it bigger, but do it in a way that fits my lifestyle a lot better, passively invest. So those are two of my portfolios. Parkview Apartments were invested as a limited partner, and Sunnybrook Apartments were invested as a limited partner, which is passive investment, and also a general partner as well. And the partners we typically work with have about 500 to 1,000 units in their portfolio. Our goal is really to help investors reach their financial goals through exceptional real estate syndications. We use a data-driven approach, conservative approach, with our experienced and reliable sponsors. And our goal is really to develop a meaningful and long-term relationship with our investors and partners. Here are some of my team members with our advisor, David Monroe, a CCIM. He's a certified investment member of commercial real estate. He also teaches market analysis. He has a wealth of knowledge in the space. And our underwriting consultant, Derek, who works in a $36 billion investment group in acquisitions, asset management, and disposition. So a lot of experience in the team. And so our key core products is real estate syndications. It's basically a security offered by general partners like us to passive investors governed by SEC, Security and Exchange Commission. In 2020, over 120,000 investors participated in syndication with an average size offering of $3 million. And typically, there's two type of offerings, 506B and 506C. So eventually, we just pull our resources together in the model called syndication, whether it's partners' time and our expertise, or some of our funds and also our limited partners funds to invest in LLC, where there's passive or active investors to own real estate. And some of the top reasons people invest in real estate, Brendan will cover in a little bit, but is really when we pull up resources together to purchase something bigger like apartment complexes or some of the assets like self-storage, we're able to invest in truly recession-resistant assets. And we don't have to worry about tenants and toilets, huge tax savings, and we're going to get access to much larger opportunities without putting our personal credit or liabilities at risks as well. So typically, for example, this is an example project. What we'll see is that we, on average, have a cash on cash of 8%, average annual return of 17.8, a equity multiple of 1.87. That just means with a $100,000 investment throughout the course of 5-year hold, for example, there was $187,000 projected returns or returns that we're seeing through the term of the hold. So that's a little about me, but without further ado, I'd like to introduce Brendan Hall. And if you're interested about passive investing in general, please feel free to reach out. And let me know. But I want to just really dedicate the rest of the time to Brandon here. I'm looking across here because he's on the other screen on my monitor. Um, but Brandon, he's the managing partner of the Real Estate CPA. He and his company just really dedicate their time to help real estate investors to help minimize their tax liabilities. He's a national speaker. I've seen him in a lot of these conferences I've attended. So we're just really, really honored for him to be here with us today. Without further ado, Brendan, I'm going to pass it to you, and you can continue to talk and expand on the topics that we'll talk today is how real estate investors pay little to no taxes, and also through syndication as well, the model that we mentioned a little bit ago.
Okay. Thank you so much for having me. I really appreciate it, and appreciate everybody that is listening in, taking time out to learn a little bit about taxes. I promise to keep it a little bit fun. So I am Brandon Hall. I run a CPA firm that has national reach. So we have clients in, I believe, every single state at this point. We have about 800 clients nationwide. I have 33 employees, and we are a fully remote firm. So totally virtual, which is really cool. Helps us with the talent issues that accounting firms face. We can grab talent anywhere, but also helps us service clients anywhere in the country as well. So we're very familiar with all the state tax laws and help people navigate them. I started the firm back in 2015. Technically, 2016, I went full time into it, and I've just been kind of building ever since. But we are solely dedicated to real estate, the real estate industry. So we work with a lot of real estate investors, small investors, large investors. We work with syndications and funds. Our largest fund has $1 billion under management. We are their CFO. We talk to all their investors, manage their accounting processes. So we can scale up to like some really big stuff. Most of our clients have about 10 rentals, kind of in that range, earning $400,000 or $500,000, net worth of a few million. And we're able to help them just mitigate their tax. And a lot of our planning is really around like, a lot of people think real estate tax planning is let me buy real estate and eliminate my income. But the reality for most people is it's let me expand my income without also increasing my taxes. And I call it the Warren Buffett approach to investing, because Warren Buffett is famously known as having a lower taxes than his secretary. But what they don't tell you is he actually pays millions and millions and millions of dollars in taxes. He just has a lower effective tax rate than his secretary does. And he has that lower effective tax rate because he's investing in a way that reduces his overall tax on his overall income. And that's what we try to teach real estate investors. If you buy one rental property, let's say that you have $100,000 of W-2 income and you pay $20,000 of tax, your effective tax rate is 20%. But if you add a rental property that cash flows $10,000 and you depreciate it in a way that eliminates the taxable income, so even though you had cash flow hit your pocket of $10,000, you've got enough depreciation to cover the entire $10,000. So you get to tell the IRS that you actually lost money on a tax basis. Well, what you really have here is now you have $110,000 of income, but you still have the same $20,000 in taxes. So your effective tax rate has been reduced from 20% to 18% or whatever that comes out to be. So that's what we're trying to do. We're trying to help our clients expand their income while keeping taxes relatively the same, ideally reducing the actual tax bill, but at least keeping taxes relatively the same. So we want income to go up, taxes to stay the same, and that's how you reduce your effective tax rate. And that's the long game. That's what we try to help people do over time. Now, whenever I talk to real estate investors, I always start with the passive activity loss rules, which we're going to talk about today, because those are the most important rules for you to understand if you want to achieve what I just told you, that expanding my income, but keeping my taxes relatively the same. You have to understand the passive activity loss rules. So I'm going to share my screen, and we're going to go over a little presentation that I put together for this session. So the passive activity loss rules say that every dollar of income that you earn is either passive or non-passive. So think about it as like two buckets of income. Every dollar that you earn goes into one of these two buckets. It goes into the passive bucket or it goes into the non-passive bucket. Any trade or business in which you do not materially participate is passive. So if I invest $100,000 into my local hair salon for expansion purposes, and I'm not materially participating. I'm not cutting hair. I'm not making business decisions. I'm literally just giving them capital. I'm sitting back and collecting checks, profit, right? That's a passive business activity for me. That is that income that I receive from them will go into the passive bucket. At the same time, my W-2 income, my business income, gain on stock sale from Apple and dividends and interest, all that stuff, that goes into the non-passive bucket. So in my passive bucket is any trade or business that I do not materially participate in. In my non-passive bucket is any trade or business that I do materially participate in, like my CPA firm or my W-2 income or gain on stock sale or dividends, interest, etc. The other type of passive activity is rental real estate, unless you qualify as a real estate professional. And we're going to go over what that means here in a second. So again, think about it as I have two buckets of income, any trade or business that I don't materially participate in, and all of my rental real estate goes into the passive bucket by default. What goes into my non-passive bucket is everything else, my earned income, my W-2 income, my portfolio income from stock. That all goes into my non-passive bucket. I know that sounds weird, but there's a special rule that basically says all stock gains and interest and dividends are considered non-passive for the purposes of these rules. Now, the goal is to figure out either how do I get enough passive income into my passive income bucket so that my passive losses from rental real estate just offset my passive income, right? Because I can have that hair salon activity, 10,000. Let's say it gives me $10,000 of net profit every single year, and then I go buy a rental real estate, a piece of rental real estate that loses after depreciation. So maybe not net operating loss, but a tax loss. It provides me a tax loss of $10,000 a year. My rental real estate tax loss can offset my hair salon net income because it's all passive. It's all going into the passive bucket. So one strategy is to figure out, how do I create enough passive income so that my passive losses from rental real estate can be fully absorbed? And I don't have to worry about like all the crazy rules of the passive activity, jumping it over into the other bucket and all that type of stuff, right? So that's one strategy, is how do I create the passive income? But another strategy is to figure out, how do I move my rental real estate activities out of the passive bucket and move them over to the non-passive bucket? Because if I can move my rental real estate over to the non-passive bucket, then the losses from my rental real estate can offset my W-2 income, my business income, my gain from Apple stock. If I can't move them over, and if I don't have enough passive income, then the passive activity loss rules say any passive losses are just suspended and they're carried forward as passive losses. Okay, so if I can't figure out how to make my rentals non-passive, meaning moving them into that non-passive bucket, then the losses will become suspended. Again, assuming I have no other passive income, the rental losses will become suspended and they will carry forward. And that is suboptimal. It's not the worst thing in the world, but it's suboptimal. And it's suboptimal from a time value of money perspective, right? If I go to the store today and I go to the back of the store where the milk is, and there's a half gallon of milk for $1, and I pull out of my pocket a cold, hard dollar bill, but I decide for whatever reason I'm not going to buy it today. So I put the dollar bill back in my pocket. I go home. I wait a year. I come back to the store now. Oh, excuse me. I come back to the store now, and I reach into my pocket. I pull out that dollar bill, and I say, I'm going to buy that half gallon of milk today. So I walk to the back of the store, but now the gallon of milk's $1.03. So my hard dollar bill can no longer buy the half gallon of milk, because now the half gallon of milk is $1.03. I need to come up with an extra 3 cents. What's happened? Inflation has happened, right? The cost of goods go up over time, but my dollar just sat in my pocket. I didn't invest my dollar or anything like that. So my dollar actually lost value. The purchasing power of my dollar eroded. Well, the same thing is happening with your rental real estate. Okay. All your tax losses in your rental real estate, you can take them today, or you can spread them out over 27 and a half years or 39 years in the case of short-term rentals. So if I get these tax losses coming from my rental real estate today, ideally accelerated tax losses, which we'll talk about, then I want to be able to claim them today. I don't want them to be suspended and carried forward. Because if I'm suspending $100,000 of tax losses and I'm carrying them forward until I sell a rental at a gain or until I generate enough passive income, then my $100,000 is losing value thanks to inflation. The exact same way that milk increased in value and I couldn't buy it with that same dollar anymore. So my suspended passive losses, again, not necessarily bad to have suspended passive losses. It does allow you some flexibility later on. You can choose to sell a rental for $100,000 gain, and your $100,000 of losses completely offsets the gain. So you don't have to do a 1031 exchange. So not a horrible thing, but it's definitely suboptimal. Another way to think about it is nobody here, most of the people that we talk to are sophisticated enough to understand that I shouldn't park $100,000 into a savings account because my savings account earns 1% and inflation is 3%, or last year 7%, this year potentially another 7%. So if I park $100,000 into a savings account, that's only giving me 1%, and inflation's actually 3%, then I'm losing 2% per year in purchasing power. Most people kind of understand how that works, right? At a very high level. Well, when you're investing in real estate, the exact same thing is happening. You have pre-banked tax savings in your real estate. Like you could send me a real estate purchase with the cost breakout of land and improvements, and I could send you back your tax benefit that is in that real estate, right? And so what people do is they do the cost segregation studies. The cost segregation study is the practice of essentially accelerating the tax benefit that is sitting inside of that real estate. So instead of depreciating straight line over 27 and a half years, I'll allocate 30% of the value to 5, 7, and 15-year property. And then I'll use 100% bonus depreciation to immediately expense it. So I'm going to try to claw down on some of that tax benefit immediately. But I like to explain this concept to people because most people would not leave $100,000 in a bank account earning 1% interest. But at the same token, most people also think, well, I don't want to accelerate depreciation on my rental to create these big tax losses because either one, I can't claim them, or two, I'll have big depreciation recapture. I'd rather just do straight line depreciation. And it's just illogical thinking, right? You have a bank account, if you will, of tax savings sitting in these rental properties. You need to figure out how to draw down on them as quick as you can. And that's what the passive activity loss rules help you understand. Okay. So full circle, passive activity loss rules say we have two buckets of income. Passive income bucket is where all my rental activities go, unless I qualify as a real estate professional, and any trade or business that I do not materially participate in goes into my passive activity bucket. But all of my non-passive income in that non-passive bucket, that's my W-2 income, my business income, gain on stock sale, interest, dividends, etc. So I've got the task of trying to figure out how to either create enough passive income so that my passive losses can offset my passive income, or figure out how to jump my real estate out of the passive bucket and into the non-passive bucket. And we've got some case studies at the end of this that'll help you kind of conceptualize it. All right. So there's three ways to get around the passive activity loss rules. There's three ways to jump your rental real estate out of the passive bucket and into the non-passive bucket. The first is if you dispose of, okay, 1 second. Sorry. The first is if you dispose of an activity. So if you dispose of a passive activity, any passive losses that you have can offset the gain on the passive activity. So if I sold the hair salon investment for a $50,000 gain, my rental losses can offset my hair salon investment gain. Okay. And any suspended losses can offset my rental gain, or my hair salon gain, up to the gain amount. If I sell a rental property, I can use rental losses from that rental and other rentals to offset the gain. If I sell a rental property, I can use losses from an LP syndication deal to offset the rental gain. If I have rental income, I can use the syndication losses from the LP deal to offset the rental income. So all of your passive activities net out together. You just aggregate them all together. There's some tax advisors get hung up on the fact that, like, oh, well, you can't use a rental loss to offset your hair salon activity, or you can't use the syndication loss to offset gain on sale of a rental activity. And that's not true. You definitely can, because they're all passive, right? These rules don't distinguish between the type of activity within the passive, like within the passive bucket. All it says is, hey, you have a passive activity, and all the passive activity gains and losses and income and losses can net out against each other. And if you ever have any sort of pushback from a CPA, it's really important if you're investing in syndications, because CPAs get really hung up on this for whatever reason. The reason is they just don't quite understand how Section 469 works. But if you ever get a CPA that pushes back, when you put $100,000 into syndication and it gives you that $70,000 loss passed back to you, that's a passive loss. You can sell another rental at a gain. You can have that loss offset that gain, offset rental income, offset your hair salon sale. If your CPA ever pushes back, just ask them to prepare a pro forma Form 8582, because they will find out real quick when they prepare that form. They don't even have to look at the code, right? We're not even getting technical. They don't have to look at anything. All they have to do is just prepare a pro forma Form 8582, and they will quickly realize all passive losses can offset all passive income and passive gains. So the first way to get around the passive activity loss rules is to sell a passive activity. The second way is if you earn less than $150,000, you qualify for a passive activity loss allowance, as long as you own at least 10% of the activity and you make management decisions, which is simply just like being actively involved. You don't have to manage the property yourself. You just have to kind of direct the property manager, and you'll qualify for this. If your earnings are less than 100K, you get a full $25,000 loss allowance, but that loss allowance does phase out as your income increases above $100,000, and it's completely phased out when you reach $150,000 of income. If you are investing in a syndication, you cannot be actively involved in that syndication, so your syndication activity is not going to qualify for this. But you could be investing in other rental activities where you are actively involved. You do own 10%, and those losses coming from those activities could qualify for this passive activity loss allowance, as long as you earn less than $150,000. So that's the second way to get around the passive activity loss rules. The third way to get around the passive activity loss rules is to qualify as a real estate professional. To qualify as a real estate professional, you have to spend 750 personal service hours in a real property trade or business in which you materially participate. There are 11 real property trades or businesses. Some of them are brokerage, development, redevelopment, construction, that type of stuff, property management, operations. So those are real property trades or businesses. You have to spend 750 personal service hours in real property trades or businesses in which you materially participate. You must also spend more time in those real property trades or businesses than you do anywhere else. So to qualify as a real estate professional, I have to spend 750 hours in real estate and more time in real estate than I do anywhere else. The more time in real estate than I do anywhere else kicks out everybody that has a full-time job. So if you have a full-time job, you can't qualify as a real estate professional. You may be able to think that you can't. You may be able to justify it, right? You may be able to say, no, I can work 4,000 hours a year and I can legitimately work. And it's a lot of work. And I'm, it's just a very sweaty startup type of gig. But the problem is the IRS is never going to buy it, and the tax court's never going to buy it. I have yet to see a tax court case where somebody substantiated the fact that they work full-time and also qualify as a real estate professional. So these are typically going to be like people working part-time, or it's going to be your spouse who stays at home. Maybe you have a full-time job, but your spouse does not, and they are able to work 750 hours and more time in real estate than they do anywhere else. And so they can qualify as a real estate professional. You file a married filing joint tax return. You have a joint real estate professional status tax return now. And now your rental activities can be non-passive, assuming that you also materially participate in the rental real estate activities. What does that mean? Well, let's say your spouse is a real estate agent for 2,000 hours and you work a W-2 job for 2,000 hours and your rentals are managed by a property manager. Well, your spouse being a real estate agent for 2,000 hours is a real estate professional. They spent 750 hours as a real estate agent and more time in real estate than anywhere else because they spent all of their time in real estate. So they are a real estate professional. But if you do not also materially participate in your rental real estate activities, then those activities are passive. So you always have to materially participate in the rental real estate activities in order to make them non-passive. Real estate professional status is just the first part to getting around the passive activity loss rules. The second part is materially participating in the rental real estate activities. And that's why you can't materially participate that's why you can't make a limited partnership investment non-passive just through your participation, because you can't materially participate as a limited partner, right? You can, a lot of times what our what our clients will do. So I'm like losing my voice a little bit. I'm recovering from a head cold. What a lot of our clients will do is they'll build out their own rental portfolio, and then they'll go and make their syndication investments. And what they'll do is they'll materially participate. They'll qualify as a real estate professional in their own rental portfolio, and they'll make an election to group in their limited partnership investments with their own rental portfolio where they already qualify as a real estate professional and they already materially participate. And then they will be able to make those limited partnership interests non-passive. Okay. So if I don't do that, then my limited partnership interests, these syndication investments that I'm making, they're always going to be passive. So the only way to make those investments non-passive for me is to qualify as a real estate professional and materially participate in my own rental portfolio, and then make an election to group in my limited partnership investments with my own rental portfolio. Then I will have non-passive losses coming from those syndications. And that's really powerful because I can put $100,000 into a syndication and I can get a $70,000 loss passed back to me because the syndication is going to do the cost seg. They understand the concept of the time value of money that I was explaining. They understand that they've got this bank balance of tax savings in their rental property that they just acquired, and they want to accelerate the realization of those benefits, right? So they're going to do a cost segregation study. They're going to pass back bonus depreciation to all their limited partners. It's going to be significant, 70% on the dollar that you invest. And that $70,000 is going to be non-passive if I'm a real estate professional and if I materially participated. And now that can offset my W-2. So if I'm a $300,000 W-2 earner and I get a $70,000 offset, then that's going to save me $30,000 in taxes between federal and state, especially if you're out in California. You're probably actually looking at a little bit more. So it's really, really powerful to qualify as a real estate professional and to materially participate in your rental portfolio.
Yeah, that Brandon, I think after addressing the reps, I think it'd be good to take a quick Q&A before we get into the case studies, because I know a few questions are queuing up already.
That works. Got about 3 minutes left on this rep stuff.
Perfect.
Yep. So to qualify as a real estate professional, like we said, 750 hours and more time in real estate than anywhere else. So the question is, what hours count, right? If I have to log 750 hours, what hours count? What hours don't count? The hours that count, you have to kind of think of it as like property management type hours. Like I'm the one that's actually there swinging the hammer. I'm the one collecting the rents, communicating with tenants, structuring the leases. Those are the hours that are going to count. We have a lot of information on what hours don't count. It's not black and white. It's not clearly defined in the code. So what we do is we look to tax court cases to figure out what counts and what doesn't count. And we essentially have three buckets of hours that will not count. The first is investor level hours. Investor level hours will not count unless you're involved in the day-to-day management of the activity. Okay. So if you manage the activity on a day-to-day basis, all of your investor hours will count. But investor level hours are going to be studying, reviewing, monitoring financial statements, preparing summaries of financials and operations, doing the bookkeeping, doing all of that upfront analysis to acquire a property or invest in a deal. Those are all investor level hours. Those are all things that investors would do before placing capital. So a lot of times people will ask me, well, I spent 100 hours underwriting and traveling to the property and reviewing it and walking through it and all that stuff. Yeah, that's great. You can log those hours, but those are investor level hours because those are the same things that investors would do before placing capital. So if you are not involved in the day-to-day activity once that deal is acquired, then those hours will not count for you. You have to be involved in the day-to-day management, the day-to-day activity. Education and research hours is another big one that does not count. I have 2 tax court cases here. That's what you see in italicized. You're welcome to Google those and read the entire tax court case text. It'll be a little overwhelming the first time you ever read a tax court case, but they do kind of read like a narrative. So once you read 1, 2, or 3, you'll kind of get the hang of it and you'll kind of be able to see like what they're talking about. And I'm not asking you to go do that. So I'll kind of explain briefly what this is. But education and research hours, so time listening to podcasts, time spent here listening to me. time spent at networking events, the Bigger Pockets conference. Those are all education research hours. Research hours could be researching a new potential neighborhood to invest in, researching potential new deals or new asset types or new markets. That's all research hours. None of that time is going to count, and never has counted in tax court. But people want that time to count, right? I mean, that's easy, right? It's super easy sitting on this webinar, logging an hour saying, yeah, I learned about real estate professional status. That's really, really easy, right? And me sitting on realtor.com and logging 2 hours a day searching for properties is super easy. I don't have to move from my chair. I want that time to count. But the problem is the IRS will never count that time. Neither will the tax court. So be wary of CPAs and tax advisors that tell you that this time does count. There's literally no evidence to suggest that this time does count. But you have to be really careful because there are people, gurus, CPAs, educators, etc., that will tell you that this time counts because they want your business in some way, shape, or form. And you need to be very careful. You always have to ask, like, what's in it for them? Why are they telling me that this counts? That's what we have seen. We have seen a lot of CPAs and tax advisors tell their clients that this does count. Then when you do a little bit digging, you realize their sales pipeline is not very good. So they're just trying to win people as clients left and right. And they're going to tell you whatever you want to hear. We stand by the fact that no, we tell clients what you need to hear to win IRS audits. I could care less if telling you education and research time doesn't count. I don't care if that makes you mad as a client, right? Because I've got 300 other people that are knocking at our door that want to come work with us. So we stay with that high integrity. We tell you what you need to hear, not what you want to hear to win IRS audits. But I've been trying to do a lot of education on this because there's a lot of people out there that haven't read all the tax court cases and they are telling people what they want to hear. Of course, you want to hear that education and research time counts. Like I said, I could sit on realtor.com for 2 hours a day and that would be super easy. I don't have to even see my property. And I could be a real estate professional because the CPA says I can. Problem is when you get audited, you're going to lose that. I know because we've been called into many audits ever since we produced this. We wrote a 12,000 word guide on real estate professional status back in 2020. And we've been called in on a lot of audits and everybody loses on education and research time every single time. So we haven't had one where they've won where a bulk of their time was education and research. The third bucket is travel time. Travel time is one of those maybes. If it's local transportation, like I've got a local portfolio that I'm traveling to on a daily basis, travel time can count. If it's like an hour and a half away or more, travel time is not going to count. So it's got to be integral to the day-to-day operations of the property. So if I visit, like I have a beach home, right? And I'm doing the short-term rental stuff, material participation stuff on that. But I can't count my travel time because it's 2.5 hours away. Even though I travel there probably once a month, I can't count my travel time because my travel specifically is not integral to the day-to-day operations of the property. Once I'm there traveling to and from Lowe's and Home Depot, that's integral because I'm doing the repairs now, right? I'm buying fixtures and things like that. But traveling that 2.5 hour trip is not integral to the day-to-day operations of my property. So that's the key about travel time. All right. Real estate professional status is highly litigated. We get a few tax court cases on it every single year, and behind those are thousands of audits. So don't jump into this. Like the mistake that I've seen in the past is people only hear the benefits and then they don't think about the risks and they don't think about what they need to do to actually substantiate it. The benefits are that once I'm a real estate professional, if I materially participate in my rentals, any of my rental real estate activities can offset my W-2 income and my business income. So it's extremely lucrative, but it's not a loophole. The passive activity loss rules were implemented back in 1986 to close the loophole of high income earners investing in rental real estate to offset their income. And then this was added later to provide people that are in real estate full time a way around the passive activity loss rule. So it's not a loophole. And just be really careful, like getting into different real estate groups that like really promote qualifies real estate professional, because most likely they're cutting corners, and you just don't want to cut corners in this type of ball game because you will lose the audit. All right, before we hit excess business losses, let's hit some questions. Then we'll hit excess business losses because this will be important to understand as a real estate professional, and then we'll do some case studies.
Got it. We'll address 2 of the questions in Q&A, and then we'll keep on going, and then we'll come back to the remaining questions.
Yeah.
So Jeff had a question. When calculating the Texas franchise tax after the sale of a Texas property, do you have to include the sale price of the property and the annual revenue when calculating this tax? Or do I just use the revenue for this tax? I understand there's no tax if your income is less than 1.1 million. It's very specific.
Yeah, unfortunately, I'm not going to be able to answer that one. I'm not our California guy on the team. We do have California tax pros on the team, but I'm not going to be able to give you a good answer to that. Sorry.
Okay. I think this is Texas, but
Oh, Texas. Okay.
the person does live in California. I know.
Oh, yeah, Texas. Texas. I don't recall having massive franchise tax filings. So, I mean, I'm pretty sure it's like $50 to file. I would have to remind myself how that gets calculated. Yeah, sorry.
Yeah, no worries. It is very specific. Another question is, can a primary residence be used as short-term rental and utilize your non-passive strategy to offset tax obligations?
I'm sorry, I coughed right in the middle of that. Can you repeat that?
Sure. Can a primary residence be used as a short-term rental and utilize your non-passive strategy that you just mentioned to offset tax obligations?
Maybe. So it just kind of depends on how you're using your primary residence as a short-term rental. If you rent your primary residence out for 14 days or less during the year, you actually don't have to report the income at all. But if you're talking about turning your primary residence into a short-term rental, you can definitely, I mean, if that's viable in your area, check your regulations, make sure that if you're in an HOA that you check that as well, assuming that all checks out. If that's viable to do, then yeah, I mean, you can start depreciating the property, but the cost basis is going to be what you originally purchased it for. So that depends on how long ago you purchased it. It might not generate enough depreciation to offset the cash flow, and you're not going to be able to bonus depreciate it most likely at this point. I say most likely because there are some situations where you still could, but you most likely can't bonus depreciate your primary residence when you turn it into a short-term rental, just because of the rules around bonus depreciation. So that one would have to be something that is analyzed by our team or a CPA or something like that.
Great. And I think we can move on to the case studies, and then we can come back to the remaining questions in chat.
Okay, sounds good. All right, so before we hit the case studies, I've got excess business losses. Excess business losses were implemented in 2021. And basically what it says is you cannot take business losses in excess of 250K or 500K in excess of your income. So let me explain what this means. If I have a $1 million W-2, and that's the only income that I earn, I don't have any other businesses. I'm not invested in syndications or anything like that. I just have $1 million W-2. And then I go and I buy rental real estate or I invest in a syndication. If that rental real estate or the syndication is non-passive, then the highest amount of loss that I can claim is $500,000, assuming that I'm married. Okay. So the point that I'm trying to make with the excess business losses, I can always offset my business income, but beyond business income, I'm capped at 250K if I'm single, 500K if I'm married filing joint. So if I only have $1 million of W-2 income, the cap of losses that I can claim from being a real estate professional or, the short-term rental loophole or anything is $500,000. That's the cap. If I have $1 million of business income, let's say my CPA firm, I net $1 million. So $1 million of business income. Now my cap is $1.5 million. It's my business income plus the 250K or 500K cap. So I just want people to know that the real estate professional stuff is great. The material participation stuff is great, but there is a cap if you're not generating business income. You will not be able to offset all of your income if you're a high income earner. So keep that in mind. All right, case studies. So we have person AB here. They earn $600,000 a year via W-2. AB files single and invests $100,000 in a real estate syndication. The real estate syndication allocates $70,000 of losses to AB. AB does not materially participate, and they are not a real estate professional. So what this means is the $70,000 of losses is going to be passive per the passive activity loss rules, right? Because AB does not materially participate and is not a real estate professional, the AB loss, the losses are passive, and they are reported on Form 8582, line 2B. Now, what was Form 8582? Let me pull that up. Form 8582 was the form that I told you to have your CPA prepare to show that all the losses and all the income net out when we're talking about passive activities. So my losses from a syndication are going to go right here, negative $70,000, because line 2B is all other passive activities with a net loss. 1A, B, C, and D is for my rental real estate activities with active participation. Well, I'm not actively participating in a syndication deal, so I'm going to report down here to A, B, C, and D. And then line 3, you'll see you combine everything. So I'm going to combine my rental real estate activities with all of my other passive activities, and I'm going to calculate it on line 3, and that's going to carry over year to year to year if I have suspended losses. So this is the form that is a very quick way to show people, yes, my limited partnership losses can be offset, or can offset my my rental income, my gain on rental activities. Whenever you have a gain from a rental sale, it's reported here, line 1A. So it's treated as passive income for Form 8582. So it always offsets everything. But this person had a passive loss of $70,000, had income of $600K, but they didn't materially participate. They weren't a real estate professional. So the $70,000 of losses is just reported on Form 8582, and it's carried forward. It's a suspended passive loss. All right, case number 2, same facts, but now we have a spouse, and our spouse materially participates in the rentals and is considered a real estate professional. So now person AB invests $100,000 into a real estate syndication. The syndication allocates $70,000 of losses to AB. And because their spouse is a real estate professional, because they materially participate in the rentals, they are going to make a 9 election. So this is 9G. The full citation is Treasury Regs section 1.469-9G. But this election is available to real estate professionals to treat all rental real estate activities as one activity for the purposes of material participation testing. So when you make this election, this $70,000 of losses is grouped in with their own rentals where they already materially participate and they already qualify as a real estate professional. And as a result, the $70,000 of losses can now offset AB's W-2 income. So we're going to reduce the $600,000 by $70,000, and we're going to realize probably $30,000 to $35,000 of tax savings as a result. But the key facts are that we already had a rental portfolio. We have a spouse who's able to qualify as a real estate professional, and they're able to materially participate in the rental portfolio that we already have. Then we make the 9 election to group it all together. And now the $70,000 of losses is non-passive.
Thank you, Brandon. I love those case studies. It makes it a lot more realistic to look at. Yes. Thank you.
Yeah, no problem. All right. Case number 3. So we're going to assume the same facts as the prior cases. But now we're investing $1 million into a syndication, and we're being allocated $700,000 of losses. We also want to assume that our spouse earns $100,000 as a real estate agent, or between the real estate agent and the rental income. My spouse actually earns $100,000. So the $700,000 of losses is non-passive, and it's non-passive because my spouse materially participates in the rentals. My spouse is a real estate professional, and we're going to make the 9G election to group this $700,000 of losses, this limited partnership activity, in with our rental portfolio. So the $700,000 is non-passive. But due to Section 461L, which is the excess business loss section that I talked about, we can first claim $100,000 because we had $100,000 of rental income, net rental income, and agent income. So we're going to claim $100,000 of the 700, but then we're limited to claiming an additional $500,000. So what happens is we're able to claim $600,000 of this loss between offsetting my 100K of business income and the extra 500K that we can claim. But there's a remaining $100,000 because we had 700K that was allocated to us. And that remaining $100,000 will be carried forward as an NOL. So it's going to be carried forward in future years as an NOL, and you'll be able to offset future income with that NOL. Now, the facts may change depending on your activity, depending on how much you actually participate. So just think of this as a very, 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 very high level example of how the excess business losses actually work.
Mhm.
So just know that you might not be able to claim the full 700K allocated to you.
Got it. And the NOL is a loss of some sort, right? I think you mentioned earlier.
Yeah, the net operating loss.
Net operating loss. Okay.
Yeah, the remaining 100K is treated as a net operating loss. Will be able to be carried forward in the future years.
Yeah, and also you mentioned something here that some of the listeners may not be familiar with, which is the amount of passive loss in syndications. And the examples you've given here is not uncommon. Would you say that of like anywhere between 20 to 70, sometimes can even be up to 100% depreciations on the investment amount, depending on if they used bonus depreciation or not, right?
Yeah. I mean, when you buy a home, when you buy a single family home, you can typically bonus depreciate, I don't know, roughly 18 to 20% of the purchase price. And there's a lot that goes into that, but at a high level, that's kind of how I underwrite it personally. When we're talking about a multifamily home, it's more like 25 to 30% of the purchase price. So if I'm investing in a syndication that's, buying a $10 million multifamily home, we're looking at $2.5 to $3 million of bonus depreciation. And the way that you figure out how much of that bonus depreciation, what sort of tax loss is going to be created from that and what's going to be allocated to me. Let's say that this $10 million building generates $3 million of bonus depreciation. And let's say that the syndication tells me in their pro forma before I invest that we expect to net $300,000 from our operations in year one. So if we're going to net $300K from our operations in year one, and we have $3 million of depreciation expense, we're going to have roughly $2.7 million of tax losses. Now, it's not going to quite pencil out like that, but for a high level underwriting exercise, it's a good way to estimate this. So I've got roughly $2.7 million of tax losses that I can expect. And then my next question to the syndication is, how much capital are you guys raising? Let's say they tell me we're going to raise $3 million. Cool. So we're going to pass $2.7 million back to the limited partners. But we raised $3 million total. So roughly 90% of what I invest is going to be passed back to me as a loss, right? So if I put 100K in, I'm going to get a $90,000 loss passed back to me. And yeah, I would say that most of the K1s that we see are probably 70 to 85% of the amount invested.
Yeah.
It does depend on the operating agreement though. So, if you're looking at your K1 right now and you're like, well, that's not what I see, probably because your operating agreement's a little bit different. But that's kind of what we see.
Yeah, exactly. That's one of the reasons our investors love investing in real estate syndications, the tax benefits, apart from the tenants and toilets aspect as well.
Yeah.
Thank you, Brendan, for expanding on that. And I know Brendan moved on to this slide. If you want to talk a little bit about that, and I know Brendan's Facebook group is super awesome as well.
Yeah. So you can find us at therealestatecpa.com. That's also my email. You're welcome to email me. If you do email me, just know that my EA Jessica will most likely be air traffic controlling your email. I get lots and lots of email questions and have very little time to actually answer them. So I'll just apologize up front. I wish that I could answer everybody's tax questions. But definitely check out that Facebook group, the Tax Smart Real Estate Investors. It's something that we started like 14 months ago. We have almost 9,300 people in it now. A lot. Most of them are real estate investors. Some of them are like other tax pros that are kind of just around the internet. But we have a lot of people in that group asking questions, especially now because people are getting their tax returns back from their CPAs, and they're like, how do I have the conversation with my CPA about Section 469, the passive activity loss rules, my limited partnership interest, that type of stuff. So we're helping people just kind of, this is my like larger vision of, it's my larger why is to, our group, the realestateCPA.com, we're pretty expensive to work with. And my larger kind of vision is to help all landlords. So that's why we created Tax Smart Real Estate Investors, is to really try to help people at scale, kind of do a one-to-many sort of education thing. But yeah, go check it out. We'd love to have you in the group.
Awesome. Thank you, Brandon. And I think for the rest, we're going to move on to the Q&A session here. And again, Brandon, Shannon has a question that just popped up. If you have a course for real estate investors, I know you do. I've seen some emails from you as well.
Yeah, we do. And we should actually get you set up as like an affiliate, because you can give everybody a discount, and then you can also get a little bit as a result. But we do have a course. We run it once a quarter or so. We have what we call a Tax Smart boot camp and a bookkeeping boot camp. So we run both of those boot camps about once a quarter. We're doing the bookkeeping one right now. The next tax one, I think, will be like June, July. But yeah, if you join that Facebook group, you'll see it pop up.
That's awesome. I need a bookkeeping one. It's a little bit of a mess for me now, but yeah. But you have Brendan's contact. If not, reach out to me afterwards. I can provide that as well. You also have my contact in the the virtual background here, Micy at lifemissioncapital.com. Now let's move on to some of the questions we have. We had some in the chat. One was about how do we make that election to group LP investments into active investment portfolio? Is there a form to file?
So the election is the 9 election, and it's under Treasury Reg Section 1469-9G. That's the election to group all rental real estate activities together as one. You do have to make the formal election and attach it as a statement to your tax returns. If you're self-preparing, most of the time there's just a checkbox that you have to check, and the software will generate the statement for you. If you are not self-preparing and you're hiring a CPA, you just need to make sure that they make the election, because that is one of the mistakes that sinks a lot of tax preparers in audits, because the IRS is pretty unforgiving if you mistakenly don't make that election. You do only have to make it one time. So you don't have to make it every single year. You just have to make it one time, and then it's in effect for every following year until you revoke it. And I've never seen one revoked.
Got it. And then we mentioned about syndication. There is the position of general partners like us, and also LPs, limited partners. But from an hours that count standpoint, as a general partner, would be involved in investor relationship count, like compiling financials and the monthly quarterly statements, which is still day-to-day activities. But would that count? That was the question from one of the participants.
So it depends on what your role is as the GP. It depends on if you're truly the sponsor or if you're just somebody that's raising capital for the sponsor. Now, one of my partners at the firm disagrees with my stance on this, and his reasoning is sound. His reasoning is, if you're on the GP side, anytime that you spend counts, because the IRS at the end of the day is not going to challenge it. They never have. We've never seen a tax court case where a GP's lost or even been challenged. So, there's probably pretty good sound reasoning there that if you're on the GP, you're probably good regardless. I like to look at things. I like to peel back the layers a little bit and look at things a little bit more technically. And I do think that you would lose if there was a technical argument, or if there was an auditor that really wanted to press the issue, if you're just the person raising capital, because you're not really involved on a day-to-day basis at that point. You're not really managing the deal. You are just an investor relations capacity. And you're not really, doing a whole lot that impacts the deal. If you are the actual GP, if you're actually coordinating with the property manager, you're making the decisions, then I would say you're running a real property operations business at that point, and you're good to go. I think there's also a case to be made for, hey, if I'm not just the capital raiser on one deal, but I'm the capital raiser on 30 deals, am I now running a real property operations business? Yeah, maybe. Yeah. So the point is on this, it's very gray. We tend to actually side with my partner whenever we're filing tax returns. Hey, you're on the GP, you're good. But we will typically explain risks to people in the sense of, if somebody pressed you on this technically, you could lose.
Got it. And next question is about how many rental properties do your clients have under their portfolio in order to be qualified as a real estate professional and use their LP investment paper loss to offset their active income? I don't think it's rental property specific, but I'll allow you to summarize on that.
No, yeah, you nailed it. It's all about the hours, right? It's not about the number of properties. There are several tax court cases where the IRS challenged taxpayers saying, you only have one rental. There's no way you're a real estate professional. But then when all the information came out in tax court, the tax court sided with the taxpayers. So you can be a real estate professional with only one rental. It just depends on the facts and circumstances. It depends on how much time you're actually spending managing your rental portfolio. We've also seen tax court cases where people have 10, 15, 20 rentals, and they do not qualify as a real estate professional. So it's not about the number of properties. It is solely about the number of hours and the quality of hours. Remember, we don't want to be logging the investor level hours, education, research, and travel time.
Got it. I know we're almost time here. We'll have maybe 2 questions left. Do you want to keep on going or you're
Sure.
Okay? Wasn't sure about your time. And so what's the risks of claiming too much loss while the lender see as a flag when we want to lend more money to purchase more rental properties?
Where is that question?
Yeah, what are the risks of claiming too much loss while the lender see it as a flag when we want to lend money to purchase more rental properties?
Great question. We have never had an issue with lenders because, well, I shouldn't say we never have. We have issues with lenders, and then the investor gets a new lender and they're totally fine. The key is to get a lender that understands what's happening. Lenders will add back depreciation and bonus depreciation when calculating your DTI. And if your lender's not doing that, then most likely that lender is not actually working with a whole lot of real estate investors, and you should be looking for a different lender anyway, because your lender, and I can speak from personal experience, both on the business side and the real estate side, my lenders are like my best business partners. You've got to have really strong lending partnerships as you scale a portfolio, and you want them to understand what's going on. But most of the lenders that work, every lender that I've ever worked with or that our clients have ever worked with that work with investors on a regular basis, this is all fine. Bonus depreciation is fine because they just add it right back for DTI purposes.
Got it. I think last question is about the bonus depreciation. I think there may be 2, but the last 2 questions. One is about bonus depreciation, how it's going to look like going forward with this being the last year.
Yeah, so this is the last year for 100% bonus depreciation, but next year we have 80, and you probably won't even feel it next year. The year after that, we have 60. You'll probably start to feel it then. And then in 2025, it goes to 40, 2026, it's 20, 2027, it goes to 0. My expectation is probably 2024, 2025, we get new legislation that delays the sunset or just eliminates the sunset. Because we've had 50% bonus depreciation before 100% bonus depreciation came into effect. 100% was just a boost, a temporary boost from prior levels.
Got it. And we'll have a question about, can we offset K1 income from a business with a property bonus depreciation?
Yes. If you receive K1 income from a business, the first question to ask is this passive or non-passive? Because a lot of times CPAs make the mistake of just assuming that something's going to be passive or non-passive, right? Based on how it's reported on the K1. So business income is reported in box 1 on the K1 as ordinary income. And a lot of CPAs will just automatically assume that that's non-passive because the software assumes that's non-passive. But if that's from my hair salon investment where I'm not materially participating, that's passive income, right? And so I would tag that income as passive. And then that passive income could be offset by my property bonus depreciation if it's also passive. Or maybe that was non-passive income, like my CPA firm income to me is reported on a K1. That's non-passive income. So if my rentals produce bonus depreciation, produce tax losses, and those tax losses are non-passive, then yes, those rental losses can offset my K1 income. Yeah.
Got it. I think this is the last one. Understand there are specific short-term rental loss rules. Can you talk about that?
Probably not in less than 10 minutes. So if you want to learn about that, go join that Facebook group. We talk about it there all the time. And we also have that boot camp, that Tax Smart Investors boot camp. And we talk about it for an entire week on that boot camp, and we do a live Q&A and everything. So I highly recommend checking that out.
Cool. I think that's it. Yeah. Thank you so much for staying a few extra minutes and answering the questions. And thank you for being here right after recovering as well. So for making it, being so consistent in your speaking engagement, really appreciate that.
Yeah, absolutely. Thank you for inviting me, and thank you everybody for sticking through the presentation. I appreciate it.
Yeah. Well, I'm going to stop the recording here shortly, and thank you guys.